Good morning, everybody. It's a great pleasure to be here. A very great pleasure for Santander to be sponsoring this event. We were associated last year and saw some real value in continuing that association with the BVCA and indeed spend a lot of our time working with BVCA members. It's an equal pleasure for, you seem a long way away over there. An equal pleasure to introduce my guests. Belinda Berkeley is Managing Director of the Good Care Group and Tom Smith is CEO of GlobalWebIndex. Both of these businesses are portfolio companies of Santander Growth Capital. Both of them have taken 2 rounds of finance from us, but in very different ways. So both high growth businesses, both very exciting, but in very different sectors. And what we wanted to do in the short space of time that we've got this morning really is to explore the different approaches that they've taken to funding their growth. So first of all, let me come to both of you to introduce your businesses so that we have a context for the audience to understand this conversation. Belinda, let me come to you first.
Okay. Thank you, Darren. So we are a professionally led live-in care business, looking after mainly elderly clients in their own homes. We care in complex conditions, so the vast majority of our clients are living with dementia. We are national. We operate throughout England and Scotland. We have 3 offices. We employ around 900 people. About 100 of those are working in offices and through the sort of regional care teams, and the remaining are professional carers.
Okay, great. Thank you very much, Tom. GlobalWebIndex.
Yeah, so we're a very different business. I'm the founder and CEO, and I founded a company in 2009, and we basically help our clients understand their audiences. So when they're building marketing campaigns, they want to know who to target, where to target, and how many people they reached. So we're basically a data solution, and we collect data through market research and analytics, and we do that in over 40 countries, and we sell that to clients in a subscription model. So we have a SaaS business model, and we work with clients from Facebook to Unilever to very small sort of businesses like we work with a furniture company in Austria, for example, but they all have the same use case. It's about understanding their audience. And business is now 110 people, based primarily in London. We have an office in New York, and we are doubling headcount every year, and it's growing very quickly, so very exciting.
So both businesses, in fact, growing very quickly, and that was one of the attractions for us at Santander Growth Capital. And so maybe just for a moment for my part, perhaps rather shamelessly, but we are sponsoring, so I'll give you a few words about Santander Growth Capital. We started 5 years ago with the specific aim of funding scale-up businesses, high-growth scale-up SMEs, in a way that hadn't really been done before, with debt that was structured around cash flows rather than assets. And we identified a gap between conventional secured lending and private equity or venture capital. And in the last 5 years, we've done 150 deals. We've lent more than £400 million, and most interestingly, our portfolio companies, including these 2, have contributed more than 6,000 new full-time jobs to the economy, which was one of our key measures. So you get the sense of the kind of size checks that we're writing. It might be anywhere between a couple of £100,000 up to 25 million. So it's that whole SME space. Belinda, let's come back to you. The Good Care Group also founded in 2009, but took a very different approach to funding its early growth. Can you tell us a little bit about that?
Yes, I mean, it was interesting hearing earlier about the sort of difference between the US and the UK. And it was very much the approach of the founders back in 2009 to really establish that solid platform for growth. So it was all about looking at what it took to develop a really high quality leading live-in care service. So what did we need? investment in attracting the best people available, and that was about sort of bringing in the right sort of mix of experience and talent. So what was very unique about the business at the beginning was the fact that all management and staff were issued shares or share options. So that engendered a huge sense of loyalty, which is still, with the business today. So attracting the best people, recognizing that you absolutely had to invest in the right systems, which I think is quite, again, sort of unique in the care market, which has sort of historically been a little bit, old school about approaches to systems. And I think the original shareholders took the view that they were prepared to really, they saw the market potential, but invest behind ensuring that the revenue growth was really maximised. So the first sort of 4 years, it was about funding losses to ensure that we were really maximising the growth potential.
So funding losses then to create a really high quality team that is scalable. Where did you go for that investment, and were there different sources that you considered?
So from 2010 to 2014, that was when we were really sort of, we could see the path to profitability. There was a recognition that in order to achieve our aims, we needed to have that external source of funds. So in 2015, we were looking to make our first acquisition. And that's when we started talking to banks, and I have to say most banks looked at our relatively short track record of profit. I think we had about sort of 5 months, and just said, look, that long.
I don't remember it being quite so many.
Yes, and they could see the sort of history of the business and how it had sort of kept on dipping back into and losses. However, the management team, we were very confident that that was behind us, and we'd established that platform. And so from here on in, it was sort of profitable growth. And, I have to say, when we were talking to you, Santander, it was a very different conversation. So with experience of sort of dealing with equity partners and banks, I have to say, Santander took that sort of much more of a sort of equity view, as you could see. You could understand the revenue growth, our client base. You bought into the business plan, and I think importantly the management team as well. So we managed to secure funding for that first acquisition, and that was a real milestone in terms of our development.
So your initial investors, from memory, were quite a large number of high net worth individuals, as opposed to an institutional fund. I think that's right, isn't it? Yes,
we had around 60 shareholders. And I think there was just a recognition that, they didn't have the appetite to go another round. And so it wasn't right that we, tried to secure funds from them. It had to be sort of through an external partner, which led to us doing a refinancing last year. And that's when we brought in equity as well. So with BGF, Business Growth Fund, and Santander, who sort of leveraged up again, we achieved a refinancing.
So we'll come to the Business Growth Fund shortly in that deal, but Tom, let's come back to you, because the way you funded your business in the early days was actually very different. It wasn't a series of high growths, or it wasn't an institution. Really largely much more organic, I think.
Yeah, I mean, it was an absolutely bootstrapped business from day one. So I spent 2 years working on my own at home. So it was very lean. Before I knew the idea of what a lean startup was, that's really what I was practicing.
That's very forward-looking, actually, in this flexible workplace.
So it's a shame I never discovered the book. It would have been a big help. But anyway, and I spent a year just going out pitching a concept of a PowerPoint deck, and there was really no cost at that point. So I kept it extremely lean. And to this date, we've never raised any equity. And we've basically sort of bootstrapped the business, and because the business is subscription and clients are on renewable contracts, it's been highly predictable. So we've been able to scale the cost base as those contracts have grown. And it's like we have a very clear model. I think we tracked it within 2% last year. So we can kind of forecast very clearly where the money's going to come. And because the renewal rates on contracts are around 97%, it's very predictable in terms of when that money's going to come. So it's enabled us to bootstrap up to this point.
So effectively, you funded the business on your retained profits and grew to the extent that you could afford on the back of the cash that you were generating.
And because the majority, 90% of those contracts are paid up front on terms, so it's very good for cash flow. So in terms of business model, it's very good to scale. I think if I did it again, I probably wouldn't do that because it takes much longer to build up the business, but it worked well for us at the time.
Along the way, you have considered institutional equity investments. What has been your thoughts for that, and pros and cons? And you know, it's probably still something that is constantly in your mind now, but you haven't done it yet. So what's driven your decisions?
Yeah, I mean, it's something we've constantly looked at. We had some serious offers on the table, which we gave a lot of consideration to in January. And at the time, and the business was generating a lot of cash, we were growing very quickly as it was, 100% up year on year, doubling staff, cost base was doubling. And we looked at how much we could raise, and we felt at the time we couldn't invest that money in a good way and get a good return because it was too much money to invest at the time. So hence why we worked yourself, because it kind of plugged the gap in terms of the cash flow we're bringing in plus additional debt. And with the recurring revenue model, it was very easy to service debt. So it really helps us get to the next level.
We were less generous, but generous enough.
Yeah, basically, yeah. So as we heard before, too much money can be a bad thing, and it's hard enough to actually doubling your cost base is really hard because you've got to find. It's mainly about people, and they're really hard to find.
Yeah, so. I mean, I think that was a point made very clearly by Karen and Alice around getting the right amount of investment for what your plan is, and up to a point, I guess you can scale it up or down, but there's a danger in going too quickly.
Yeah, no, exactly. And I think the obvious danger if you grow too quickly, you invest in a bad way, you hire people that are not a good fit for the business, and you spend it in a way that you're not going to get a good return. So at the time, it wasn't the right decision. I mean, we'll certainly look at it again. And our cost base next year is going to be huge. So there comes a time when I think it's an appropriate amount of money. But.
And over and above the money and the funding, were there aspects of private equity that did attract you?
Yeah, absolutely. The expertise, the credibility in our market with buyers, being able to raise additional financing on the back of having equity in the business is good. So, I mean, there were other factors, but I think the ultimate factor is whether we need the money. And at that point, it wasn't the appropriate thing to do. So.
And Belinda, coming back to you then, last year you did bring the Business Growth Fund in, institutional equity, alongside some more support from us. But what particularly drove that decision? And over and above having a partner, perhaps for future acquisitions, what did it allow you to do, I suppose, relative to all of those original investors?
So certainly the flexibility of funding and access to quick funds was really important because I think historically a fundraise had been quite sort of tortuous. We'd ended up with a really complicated share capital structure of the various rounds. So there was a sort of lack of clarity, I think, as to what the shares were valued at, and there was I think at that time a sort of lack of alignment as to sort of shareholders and management's interests. So I think what the deal that we managed to do last year was realign management and shareholders' interests for the way forward, recognising the sort of challenges ahead and the opportunity. It allowed us to also facilitate a realisation for some of the original founder shareholders, but they did, to a portion, sort of roll over into the sort of new entity. So they are enjoying some upside, But I think what we have now is a really solid foundation from which to grow. So it was a very positive outcome, I think, for everybody.
So I suppose, Tom, if we look at Belinda's experience relative to where GlobalWebIndex might be going forward, they've started from one investor base, moved to another with some debt finance along the way. My sense is that if I were in your position, I would probably think the world is my oyster. There are lots of flexible options, and particularly mixing debt with equity. To what extent are you still open-minded like that?
No, yeah, absolutely. I mean, we've been having conversations, and debt's been amazing for us to grow the business to the next level. I think at some point we'll need equity to get to the level beyond that. But I would always look at mixing the two. In our business model, with recurring revenue and incredibly predictable, it supports debt really well. So.
And I think what we'll be able to show with you, our association, this is something that we were very mindful of at the outset, is that if and when you decide that you want to take that institutional equity investment, and I'm sure there'll be loads of people here knocking at your door, you do so owning the whole business, because what we've managed to do for you is to get you to that next stage without diluting your ownership, which I guess was an important driver.
An obvious factor. And I mean, we looked at the cost of the debt, and it was essentially significantly cheaper than selling equity to raise funds. So it was a factor for sure.
Good value rather
than
cheap.
Good value. Yeah, I didn't say it was cheap, but you wouldn't. No, it was good value. I think we'll say.
I think we're coming to the end of our session, but probably worthwhile just coming to both of you for a final comment on how you see the future of your businesses, given where you are now and the outlook and the funding options for further growth that you have.
Well, certainly from our perspective, yes, I mean, very excited by the future. We have historically sort of grown 30 to 40% per annum, and we're still seeing very strong organic growth, which is obviously cash generative, but we're hoping to make a small number of strategic acquisitions as well. So, yeah, very positive. We've got the right funding partners, certainly feel secure from that perspective as well. So look forward to continuing to work with you.
Well, the feeling's mutual. Tom, more 100% per annum growth?
I hope so. Yeah, I know. So, I mean, we're very positive about the future. The market we sell into is vast. So I think although it's a more challenging environment right now, the market's big enough to support the growth that we want to do. And with the funding in place and other funding options, we're very positive we can continue to do at least double up in scale for the next 3 or 4 years. So.
Well, from our point of view, we very much enjoy our association with you. Wish you both continued success as you disrupt in your markets. Belinda Berkeley, Tom Smith, ladies and gentlemen, thank you. Thanks.